Strategy's Bitcoin position is, does anyone know? Strategy's Bitcoin position is down. In terms of they've invested at a price and the price is lower. So they're at a loss so far, which is fine. Low time preference, hold it for the long term. Okay, that's fine. Also, the MNAV, it depends on how you calculate it. Like there's 5 different MNAVs. I disagree that do you agree that taking out of the money securities and treating them as if they're equity is probably like, it's not the way to do it? Okay. Selling Bitcoin would be selling it like at a loss. Selling equity would be dilutive. And you owe billions of dollars forever. In this current market, how do you finance that? Who's burdening the cost? The one that you committed to pay hundreds of millions of dollars a month, and you want that to become billions of dollars a month.
Bitcoin has spent years proving skeptics wrong, but every bull market eventually finds a new source of controversy. This time, the debate isn't about regulation, exchange failures, or institutional adoption. Instead, it's centered on the largest corporate holder of Bitcoin in the world. Critics are questioning whether Strategy's aggressive accumulation model can continue indefinitely, while supporters argue the market is fundamentally misunderstanding how the company's financial structure actually works. The concerns have intensified after Strategy sold a small amount of Bitcoin to help satisfy obligations tied to its preferred stock offerings. For some observers, that single transaction raised uncomfortable questions. If the company continues issuing credit-like instruments to acquire more Bitcoin, what happens during prolonged periods of market weakness? Could shareholders eventually face dilution, larger Bitcoin sales, or mounting financing costs? These are the questions fueling one of the biggest debates currently taking place across the Bitcoin community. And while critics believe they're exposing a weakness in Strategy's model, Michael Saylor argues they're missing the bigger picture entirely. In today's video, we'll break down the criticism, examine the concerns surrounding Strategy's financing structure, and hear directly from Saylor as he responds to claims that the company could eventually be forced into larger Bitcoin sales. Before we get started, make sure to like this video, subscribe to the channel, turn on post notifications, and let's dive in. Buy $10,000 of Bitcoin on a regular exchange. It grows to $60,000. That $50,000 profit? You could owe $10,000 or more in capital gains tax. Now do the same trade inside a Roth IRA with iTrustCapital. That growth? Tax-free. You keep the full $50,000. Same crypto. Completely different outcome. iTrustCapital lets you hold crypto in a self-directed IRA, trade 24/7, and secure your assets with institutional-grade custody. You can also hold gold, silver, and stake certain assets. Real U.S. customer support. $100 bonus when you fund through the link below. In crypto, structure beats timing. Every time.
A perpetual preferred means it's not debt, but it's also not equity. It never converts to equity. I don't know what it is. And I'm doing this humbly. Right? I have no idea. You guys are the experts. You'll tell me. But you owe the money forever. So you're creating a liability that you need to pay forever. Unless you just tell the, preferred holders to go screw themselves. And if you can't afford it, which technically some of these companies can do, I don't think they would. I think it would tarnish their credibility. But if you say, okay, how do I come up with $2 billion a year that's going on, according to these charts and these models people post, $200 billion a year. But let's say, okay, I owe $2 billion a year. But you don't make $2 billion a year. You're not doing anything productive in the economy to produce cash flow that can afford the money that you want to give to your grandmother. So who's coming up with the money? And it's like, you can either sell Bitcoin, which is fine, but this is a trade then, and the trade is path dependent. If Bitcoin is not only going up enough CAGR, but predictably and reliably going up, like what if it's in a bear market for 5 years? What if it's in a bear market for 2 years? What if Trump drops a nuclear bomb on somebody? So there's a path dependency to the performance, or you can sell the equity. But obviously, the way MNAVs are calculated, I also don't understand. There's way out of the money securities that are being counted as equity, which nobody would ever do in an M&A transaction. And so selling the equity in this market right now is highly dilutive. Or you can just let these things that are marketed like a money market fund bleed down and not, ratchet them back up to the $100. And so I just disagree with I just don't understand the premise whatsoever. Okay, your grandma wants 10%. I'm not about your grandma, more just broadly to human beings. I would say there's two ways to increase wealth. And this goes back to like Austrian school of economics, is like you can either be more productive in the marketplace. So like people are giving you money in return for what they perceive to be value. So if you want to be wealthier, produce more value for the world. Or if you want more wealth on net, like excess cash at the end of the month, spend less, reduce your lifestyle, consume less shit. Either produce more value or consume less shit. At the end of the day, Austrian School of Economics 101, that's how you produce more wealth for yourself. Saying that like someone's going to magically just like give you 10% yield, again, can someone financially engineer that? Maybe. But I think these are real questions, is like in this current market, like it feels like when it comes to financing these dividend payments, like someone is burdening that cost right now, right? No? Can you explain that to me?
Yeah.
Thank you.
So we opened up a whole new
We are not
can
talking-
of worms here. But what a start for the next
Sorry.
conversation. No, it's perfect. It's perfect. I think we do a little change of the program and skip the questions and let the gentleman address the question.
There is only one small nuance, Judge, if I dare. It's not 10% of value that you're delivering. It's 10% of dollars. And that's a huge difference. This is really, I think, where they are coming from. We are not promising 10% of return. It has nothing to do with 10% of return. It's 10% of yield in dollar. And dollar is going this way for 100 years. Because the amount of dollar issued increases by $1 trillion every 67 days. So I don't believe he will be able to deliver 10% in dollars. I'm absolutely sure about that. There is no way he doesn't do it. But, unfortunately, we have questions, but I would really love to spend 2 minutes with you after
So first of all, on the ego point earlier, like this is me killing ego entirely. I could be missing something, uneducated, the dumbest person, and I'm totally open to that. So I'm not coming at this of a place where I'm right whatsoever. I think this is super important. Let's take strategy, for example. It's the most common example, and it's relevant enough in the most popular Bitcoin anything where I know the numbers off the top of my head. And by the way, I don't know if Michael's here. Love Michael. Super net positive for Bitcoin. Like I have not a bad word to say about Michael. Strategies, where is he?
He's behind the door.
So strategies, I mean, he could come up here if he wants. Strategies Bitcoin position is down. Does anyone know Strategies Bitcoin position is down, which is fine, but it's down. Yeah. There isn't there.
In terms of numbers of Bitcoin?
No. In terms of they've invested at a price and the price is lower. So they're at a loss so far, which is fine. Low time preference, hold it for the long term. Okay, that's fine. Also, the MNAV, it depends on how you calculate it. Like there's 5 different MNAVs. I disagree that do you agree that taking out of the money securities and treating them as if they're equity is probably like, it's not the way to do it. Okay. Selling Bitcoin would be selling it like at a loss. Selling equity would be dilutive. And you owe billions of dollars forever. So in this current market, how do you finance that? Who's burdening the cost? The one that you committed to pay hundreds of millions of dollars a month, and you want that to become billions of dollars a month.
The argument being raised here is relatively straightforward. Critics aren't necessarily focused on whether Bitcoin succeeds over the long run. Instead, they're questioning how strategy funds its accumulation strategy during periods when capital markets become less accommodating. If issuing new equity becomes less attractive, and if certain financing vehicles lose investor demand, some observers believe the company could eventually face difficult decisions regarding dilution, asset sales, or future fundraising. From that perspective, the concern isn't Bitcoin itself, it's whether Strategy's financing engine can continue operating under all market conditions. But Michael Saylor believes that criticism misunderstands the entire purpose of the business. In his view, Strategy is not simply a company that buys Bitcoin and holds it indefinitely. Rather, it's a company that uses Bitcoin as capital to support a much broader digital credit model. And according to Saylor, once investors understand that distinction, many of the popular criticisms begin to look very different. Here's how he responds to the claim that selling Bitcoin under certain circumstances somehow invalidates the strategy thesis.
The key point here is the company is in the business of selling digital credit. The credit is backed by capital. Bitcoin is capital. And to the extent that the credit is compelling, then the equity shareholders create a spread and they get the benefit. It's a very simple business in that regard. You could build this business with real estate. You could build a business with gold. You could build a business with equity. But let's just take real estate. If you went to a bank and you said, I want to borrow money to buy some real estate, but I'm not willing to ever sell the real estate or pledge it to you, but just give me the money. And they said, well, how are you going to pay me back? I said, well, I'll just sell equity, but I won't sell the real estate. Well, the bank wouldn't give you the loan. If you go to any bank, you said, I want to borrow money for a house, but I'm not going to actually sign the mortgage. I'm not going to pledge the house. The bank won't give you the loan, right? And so you're not going to be able to sell credit unless the people that are buying the credit believe you're going to pay the dividend. The only way to pay the dividend is either to sell the Bitcoin or to sell equity or a derivative of the Bitcoin. If you unilaterally say you won't sell the Bitcoin, the credit rating agencies think, well, that's an impaired asset. Since they won't sell it, I'll mark it to zero, and then that means you can't get a good credit rating. So you can't really create good credit if you unilaterally impair the asset. And then if you go to the equity capital markets and you said, well, we've got a good business selling credit, and they're like, well, but you said that you're not going to use the Bitcoin to back the credit. How are you going to sell any? Well, the equity capital markets wouldn't believe in the credit business. If the credit fails, the equity won't work. And so the first order issue is if you're not willing to use the capital to back the credit, then the business isn't going to be able to sell credit, and therefore you don't have a digital credit business. But the second order effect is a short seller would say, well, it looks like you have to sell equity to pay the dividend then, so I'm going to short the equity because you have to sell it. Well, and I'm going to short it down until you trade at a discount to the asset value of the Bitcoin. And if you unilaterally tell them that's okay, you'll keep selling even though the equity is undervalued. If you went to the market and said, I will sell the equity and never defend it. Like if I said, I'm going to punch you in the face and your kids, and and unless you defend yourself, you're like, well, I'll never defend myself. At some point, you invite, I'm not saying I would do it, but I'm saying criminals and malefactors, evil people will attack you if you don't defend yourself. So if you're a short seller and you're a malefactor and you want to attack the company, if the company won't defend itself, then not only, it's worse than just, it's like, I have $1 billion of Bitcoin, but I'm not going to defend it. You can have it if you come and break into my house and steal it. I'll leave the door open. And then you tweet that. You're not just going to have one criminal. You're going to have every criminal in the country visit you, right? Yeah. You're going to attract malefactors. So a public company that's unwilling to defend its equity is going to attract short sellers, and then you would have everybody shorting the stock. Would you invest in such a company that's unwilling to defend itself? By the way, I'm running a restaurant. I give away all the food for free. People can steal from me. Would you like to be my investor? And this is common sense, right? You're not going to invest in a company that will not defend its property, right? Will not defend itself. And you're not going to buy the credit if the company won't pay the dividend. You're not going to believe the company can pay the dividend if they only use equity, if the company won't defend the equity now, will you? So if the company's policy is that we won't sell the Bitcoin, then the credit won't have value and the equity won't have value. And if those two don't have value, then instead of the company buying $64 billion of Bitcoin, which is what we've done, the company raises no money and buys no Bitcoin. And so in this case, would you rather have the company buy 200,000 of Bitcoin a year and sell 10,000 of Bitcoin a year, or buy no Bitcoin a year, sell no Bitcoin a year?
What makes this debate so interesting is that both sides are ultimately focused on the same question, sustainability. Critics are asking whether Strategy can continue acquiring Bitcoin at scale without eventually running into financing constraints. Supporters point to the company's massive Bitcoin reserves, access to capital markets, and history of adapting its strategy through different market cycles. The disagreement isn't necessarily about Bitcoin's future value. It's about how a publicly traded company should manage a balance sheet built around the world's most volatile asset. Saylor's response highlights a distinction that often gets lost in online discussions. His famous "never sell your Bitcoin" message was always directed toward individuals thinking about long-term wealth preservation. A corporation operating in public markets faces different obligations. It has shareholders, creditors, financing arrangements, and capital allocation decisions that don't exist for a typical investor holding Bitcoin in cold storage. From that perspective, occasional sales may not represent a failure of the strategy, but rather a normal part of operating a complex financial business. At the same time, the scrutiny surrounding strategy isn't likely to disappear anytime soon. As the company grows larger and accumulates more Bitcoin, every financing decision will attract attention. Every market downturn will generate new questions, and every adjustment to the company's capital structure will be analyzed by both supporters and critics, searching for signs that their thesis is correct. That's simply the reality of being the largest corporate Bitcoin holder on the planet. What happens next will ultimately depend on factors far bigger than a single dividend payment or a small Bitcoin sale. The future of strategy remains tied to Bitcoin adoption, capital market conditions, investor demand, and management's ability to execute its vision over many years, not just quarters. But one thing is clear: this debate has become one of the most important conversations in the Bitcoin ecosystem, and it's a discussion that investors should pay close attention to as the next phase of the market unfolds. If you enjoyed this breakdown, make sure to leave a like on the video, subscribe to the channel if you're new. Thanks for watching, and we'll see you in the next video.